Good afternoon, everyone. It's Chris from Solstice ATR as well as Excel. You can find us on the web under Solstice ATR, the software company for adaptive algorithm, Twitter, which is my handle, Instagram, as well as Discord. We use this adaptive algorithm for trading the side market, the up market, the down market, whether you trade equities, futures, commodities, ETFs, Bitcoin, crypto, NFTs, and many, many more. The most important thing, we're not a broker dealer. We use this for educational use only. Once again, we're not a broker dealer. Past performance doesn't give us indication of future results. If you like to take this material and copy it, please request it from the website. Check the website policy or give us a jingle at the number right down below. Once again, hit the smash button if this is good information for you. Secondly, you can subscribe to the YouTube channel and you can share it with your friends. Let's go to the first slide. And what I want to do, remember, in 2023, we started the year in January. So far, we had a good year from the bottom of the market. This is a reference point that we have to keep in mind. We want to be paying attention to the earning and the overall market. This week, the S&P had closed around 3,900. You remember, you can take a snapshot of this information so it will help you in the future. We got to look at the overall, I don't want to go over too much detail in the events that happens in the market and the battle between the bulls and the bears. But most important, you want to be fluid with the market. Whenever you enter a position and exit your position, make sure you know where your stop is. Don't hold on to a loser. Let the winner run. Take some profits on the way up. And don't turn a winner into a loser. So things to consider. We're going to consider the people's income in the United States as well as the global market. The non-farm payroll and employment in relationship to household survey of employment. I spelled it wrong here. We can readjust it later on. Real person's consumer consumption and expenditures. When you are at home, a husband and wife or an individual that makes enough money to cover the expenses and stuff, are you just barely making it along, or do you have enough money to travel, spend more stuff on toys and other stuff, computers, going out, theater, going on vacation, buying another boat, another car, or a secondary home or a vacation? So this is the things we have to pay attention to the manufacturing as well, and the industrial and the wholesale and the retail side. How much cost has it been? Is inflation coming under control? And we have to pay attention. This is something, that drama that happened this week by Yellen talking about the debt ceiling, like in 2011 when Obama was in administration, and what they did in July of 2011 to solve this issue, because they were saying, hey, United States going to default. Are we going to invest in the bond market, or people are going to pull out their money out of the treasury bonds, the long term and the short term, and as well as the midterm? So we have to pay attention to the debt ceiling according to what the Feds do regarding the inflation. Are they going to slow down the interest rate as well? Stop their tightening on budgets so businesses can go and individuals can go spend money and borrow money from the banks. Let's go to the next slide. The next slide, excuse me. The next slide, I have the Global Fund ETF from Vanguard. It's VEU in relationship to the TBT. The TBT is the Treasury bond long term. Interest rates is coming down. You can see it. This is the blue one. When interest rates are up, market is down. When the market is up, interest rates is down. Now the interest rates was up here, starting to nickel down. It tried to rally. Now it's coming back. Does it break this consolidation where it started in February 19 of 2020? 2020 COVID-19 and the March 23rd low? You can see interest rates started to stay low. The par value started increasing. Now we're coming back down after the push up. We were at low interest rates, then they started nickeling it up, and you can see it created the combination of the TBT in relationship to the global fund ETF. You can see where the peak was in August of 2021, Then the 2022 was basically a lower high and we fell apart. Now we're trying to rally back up. We got to pay attention to that. Let's go to the next slide. You can see here I have still the global fund in relationship to the IEF, which is the short-term maturity bond. I did not put the 10 and 20. I put the 5 and the 7 and the 10-year bond. This is the IEF, which is an ETF instead of using the ZF or the ZN, which is the pure contract. I'm showing where in relationship that bond value was at a peak. When COVID hit, we rallied up, we reset, rallied back up, and eventually we collapsed here in the bond. Now the bond's starting to rally up. What's the market? We got to pay attention to what the par value of that bond is in relationship to interest rates. If they do increase by 50 basis points from now till end of 2023, and the economy and the earning reports of the different stocks that are coming in the first quarter of 2023. Let's go to the last slide. Here I put the SPY, the NASDAQ 100, the QQQ, the IWM, and the Dow Jones Industrial in relationship to the VIX. We can see where we rallied. That was the November high. Then we had the December. Then we had the January didn't make the high on the combination of the four in relationship to the VIX. The VIX was trying to spike up. Every time it spiked, ran back to the 20, spiked up, ran back to the 20, hitting that $35 range. You can see here 37, between 35 and 40, coming back to the $20 range. Does this mean that the VIX is going to fall through this downtrend channel from the prior year and this channel, or do we get a reverse back because inflation as well as the earning of the companies and the manufacturing consumer products, the spending and the way we are operating? Do we have enough sustainability, even if in a slowdown, not to have an economy crash? These instruments in the small cap, mid cap, large cap, industrial, commercial, financial, consumer products, staples, technology, biotech, pharmaceutical, are going to keep us going in order to get a nice recovery in 2023. The odds are they may be a good recovery, but their earning reports on the companies may have a slowdown, but we may not get the same run that we had from 2000 and 2001, that big run. We may have a small run, but may not be as big as we want. So let's go to the last slide. Remember to hit the subscribe button on YouTube and smash the like. And you can find us by giving us a call on either those two numbers or the website. Let's go to the first slide. On what I have here, S&P, NASDAQ, and the Dow. We can see we created a lower high. If we take the high from the March low of 23 till the January 3rd of 2022, that was the high. We came back, retested the 50%, and the February 17 before the 19 reset. We bounced off the 250 SMA and the 200 SMA, came up to the 50. We tested it once, twice here, third time failed in December. January so far, this is a good reference point that the 18 simple moving average, if I zoom in here, I want to make it very clear to everyone. I use an 18 simple moving average to hold us. You can see this consolidation on the weekly. We had in December the low, December low, January was the low. We rallied. We had a nice push up. Then this week was an inside the prior week's range, but we came off Friday's low and we rallied up on Thursday and Friday. Does this mean we can continue? We have to pay attention to what's going on domestically as well as in the global markets so we don't end up on the wrong side. And I'm going to use the micro right now, which is the IWM. The micro IWM is, the micro 2K is the IWM in the ETF fund for the Russell 2000, and the IWN is the value play. We can see after doubling here at the bottom, I would reconsider that 50 if I extend it, if I right click, edit the property, and I say I want to go till 2019 just to go back one more year. I just want to show you the highs and lows that when we retested the February, January highs, This was the breakout in November 9th of that week before the December rally in 2020. And this was the close of the candle. January was the low. We rallied. We consolidated for almost a year in the Russell. We looked in November, then we failed. That was our January 2022 high. We double bottomed here. We looked up at the 50 SMA once. This was the failure of a death cross. When the 18 SMA crosses the 50, I use an 18 instead of a 50. That tells us when there's a change in the trend. We double bottomed here. We rallied back to the 50. This is test 1, test 2, test 3. December was the low. And you can see now the Russell starting to get a little bit of momentum on a weekly basis, and it's holding the 50 SMA. What we can do is go to a daily chart 1 year. And I want to show the Russell here in relationship to the overall market. I know I have the 3-day pivot on it here by accident. What I want to do is remove it, edit the property. It says on the 3-day pivot, we're going to remove it. This shows me the range in the last 3 days, if I am above it or below it, so I can trade that momentum. We can see in that linear regression downtrend that we had these stops in November as well as December. We tested that 3-time top. We failed. We created some kind of a triple bottom on a daily chart here. January low of 2023 is higher than this. This is a very important reference point on this big rally. This week, the Russell gave part of the move back up. If you can take this low here to this high, if we take a channel or a line, I want to zoom in here just to explain it. If I take this low from here to this high here, that was almost a 9.8%. The Russell had to give up some of the return, and if I put it up here, that's a 7.5% in less than 3 weeks in the Russell after the holidays. We had the January 3rd, when we came back, it was a short week. Martin Luther King was another short week. And this week was basically this trending week. We fell down on Wednesday, Thursday, then on Friday, we rallied back up, part of that move. Does this mean we can continue? We have to pay attention to what the reports are and where we are in relationship to all the instruments. Let's go now on the daily. And what I want to do is take a look at RSP. The RSP is basically Invesco's exchange traded S&P equal weighted fund. We can see we created this bottom. The lift at the 200 SMA came back above the 200 and the 250, fell back down. We did hold Thursday, Friday, the 50 simple moving average and the 18. You can see they are, intertwining, tangled up between each other. But remember, if the 18 can cross like it did here, you remember how the 50 crossed? We want to make sure that the 18 crosses the 50 so you get a bullish cross in order for that momentum to shift. In this pattern here on the short daily chart, if I consider this as a shoulder, this is a head, and this is forming a shoulder, if it does not fail, I would consider those 4 tops at the 150 area, 150.25. Eventually, we can get a breakout in small cap to continue higher. So this is the way to trade those instruments. You can have linear regression channels, support and resistance to help you out in your trading. So usually in our group, in Discord, we have a live feed. We are basically trading in a group that are calling trades in and out on an educational basis to help you understand why there's an entry, why there's an exit, whether you're bullish or bearish, or there's a reversal from a peak to valley to a peak, or range bound, you're trading inside the prior day's range. It is very important to understand that in the last 5 days, if I take these last 5 days here, this was Monday, you can see it, 17, 18, 19, 20. This is the high. This is low for the week. If I do want to know what the range is for the week, not using a Fibonacci, I can take the low from here, to this high here, and I know my range. This is my 0, this is my 75, this is my 50, this is my 25, this is my 100, or vice versa. It depends how you draw it, in case you end up breaking above or below these levels, to know where your range for the week is. On everyday basis, you can measure those distances to know where your open is. Remove this drawing. Let's do it again. This is basically your high for the candle, your low for the candle. This is your open of the candle. You can look at it right up here on the corner. This is your open, and this is your close. Similar situation. This is the low for the day, testing on the daily chart, the 50 and the 18. This was our open. We tested the low, rallied back up to the open. We cleared the Thursday's high. This was off to the races to fill this professional gap. You can see there's a gap between this candle and this candle. We rallied up to retest the 5 SMA and close in this upper consolidation where we got the breakout, fell down, breakout, fell down. If this is the shoulder, once again, I want you to understand it. I know I took a lot of time showing it, but I want you to understand. I'm going to go now. Take a look at AAPL plus Amazon plus Microsoft plus Google plus Netflix plus Tesla. The reason why this is part of the S&P as well as the NASDAQ 100, if I put them all together, we are in a wedge. You can see that downtrend channel. And we have this downtrend channel here. Why I did this, I did not use this bottom here. You can if you want. But you can tell here, every time we tested the 50, we looked above it, failed in the 116 SMA. We tested it once, twice here, fall back in. Now we cleared the 18. We crossed the 5 and 18 off to the races. Do we end up clearing this channel to come back to the 116 simple moving average on the daily and the backside of this channel? Because this is a symmetrical triangle. The more time I spend above the 50% between here and here, or the range of the December high to the December low, and I'm above the 61.8, and we filled this gap. You can see there was a gap here. I marked it in the prior weeks on the charts. If you go back to January 1st first video that I did before the January, the December, then we came in January 3rd. I did this video and I showed it in the group, and I told them, hey, pay attention to MGM, Caterpillar, pay attention to Apple, Tesla, a couple of ETFs, Boeing, pay attention to gold. So these are the things I educate people on to understand if there is a trend in it or there isn't. Last but not least, I'm going to do Bitcoin, and I want to do ETH, and I'm going to call it a small, short weekly video. And if you have questions, reach out to us. Let's go right now. Take a look at, I'm going to use micro BT. The micro BT is the mini Bitcoin. And the reason behind it, I'm going to show you the daily in relationship to the weekly. We do have this professional gap ever since we did that double. Let me go back in the weekly just to show it here. Just for a reference point, when we did that double top here, we fell. On the regular BT, we rallied. We couldn't hold here. We have this professional gap. You can see it here. We have another one here. This one I did not mark it. We can always mark these with a little box as a reference point. Eventually, in the future, these boxes are usually fillable, and I can right-click, edit the property, make it like a purple like we did over there, extend it 2-3 days, and you can see where it is in relationship to this one here. And if I zoom in from this area all the way to my right, if we can clear, we can consolidate and create a little shoulder here. Even if we go sideways here for a little bit, eventually we'll retest the 25 and fill the gap. But if Bitcoin, Ethereum, and the crypto space is a little bit weak, will come back a little bit before continuing higher, clearing the 50 SMA, clearing the 89 EMA. But remember, we are above for the last 2 weeks on a nice push. The prior week coming in January, this was the downtrend channel. We broke out of it. We called this trade in the group. And this is a nice run, whether you took an option, an equity, an ETF, which is the GBTC, or in Ethereum, ETHE for the ETF, or Ethereum is ETH. And this is the reason why we call these trades, because we want to show the setups and the reason behind them. We use resistance and support, supply and demand zones, volume profile, and momentum indicators. And since the adaptive algorithm can show us the way, it tells us when it's going to be long, when it's going to be bearish. The short term is up, mid-term is up, long-term up, but doesn't have to continue. We are bullish on an effort to rise. On the weekly, monthly, daily are all up. But if I go, let's say, to a 4-minute bar, 4-hour bar, you can see that we can still are shifting higher, but the midterm now is overextended. It may retrace a portion before continuing, because my short term is up, long term is up, but my midterm, it can come back a little before continuing unless we get a breakout. You can see this is an ADX sprint. You want to ask me what it is? Don't, because it's too much to explain here. I do have a target in the future. If we clear the 25,350, I have a target of 27 and 29,500. You can see the cloud where it's printed. It doesn't come from me. It comes from the machine, because the conditions are met in relationship to the adaptive algorithm solutions that are built by traders and built for professional brokers, as well as accredited investor that want to learn and use the system in order to help them out to know where the ranges are, where the highs and lows for the day are, and a breakout between the ranges or above using a DMI, an RSI, a stochastic, a momentum indicator. I don't use Elliott waves at all myself. I'm more of a momentum and swing trader. It depends which account you're trading. The long term, you trade it for the whole of a 1 year, 2 year. Short term can be between a 1 week to 6 months. And a daily account can go from being short 1 minute, the next minute you're going long, or the next 30 minute you're long, the next 5 minute you're short. It depends what your style of trading is, because we can trade as a day trader, or we can swing trade looking for where there are support and resistance, and where is supply and demand, in order to enter a position, acquire it, hold it, use options against it when you are trying to hold a position. Last, I'm going to show you right now ES, which is the micro. I want to make it a little bit more easier to read. On my micro ES, we can see we were in the last 30 days range bound, 35 days. This was the December high. Then we fell back down in this area. We rallied back up. We consolidated. We couldn't clear this gap. This was a professional gap. You can see the low of the day, and this is the open of the candle. That morning on 12/15, we were not able to clear it. We cleared it here. We consolidated for 4 days, where we're thinking it's going to continue up. Then on Wednesday, we collapsed. Thursday was an inside low. There was a gap between the close of this candle and the high of this candle. You can see it. If I mark it with a box, I grab this candle and this. Once it cleared it on edit the property, I'm going to do this for everyone. So I'm going to zoom in 2-3 days in to show you those gaps in here. Usually when the gap is fillable, usually you get a momentum, and you pushed that morning, you tested the close of this candle, pushed above it, and the high on Thursday. This was given to you by basically the market card, or this downtrend wedge, or you can put a channel here to show you just looking at that short distance here in the overnight. This was a channel going up. You take the trade on a breakout. come to fill the gap. You take a portion or you add if you fill in it. You retested it again and bounced off. This was off to the races. You cleared the 38% fib. You cleared the 50. You cleared the 50 simple moving average. You continued to the 61.8. But remember, this big candle, if I measure the distance from here to here, the distance we traveled from here to here, even if we use a box, I'm going to show you how to do this. We're using a channel here. My fault. We can get a box here. Grab this box here to this one here. We set the overnight. Even if I don't do it with the overnight, this is a box. I can duplicate it, correct? If I want to look at the low in the morning to the high, you can see we got more than 2/3 of the move, not including the overnight. But if I include the overnight in this box, let's say I activate the drawing, and I include the overnight low of this box, you can see it here in relationship to the prior day's range, and I zoom it to the right. I'm going to activate it, move it to the right. You can see this whole move from the bottom, we only got 2/3 of the move, which is the 61.8. And the reason behind it, we use this if you use Fibonacci's or channels or calculate the risk of your entry or your average true range. When an instrument tells you this is my average true range, which is 67 points, my 2.5 standard deviation is 170 points. It's given us an opportunity to know how much distance we can travel in one day. And you can see the ATR was 67 points. We did 72 points on Friday move. Is this a great return? Yes. I'm not going to say much because in our group, we trade. A couple of us got 200 points on the NASDAQ. That was a good day in the market for most people that are trading the QQQ, the S&P, the Dow, or whatever you are trading as an instrument to help you out in your retirement account, saving account, short-term, mid-term, or long-term. If you once this video, I want you to give us a thumbs up. Give us your comments. Hit the subscribe on YouTube. And if you'd like to get in contact with us for more information, reach us at Solstice or the following number right in front of you. Take care. Enjoy your week. See you on Discord.